Welcome back. Well, as the UN warns that the world's fight against climate change isn't going so well, we wondered how Canada is doing. Here's a look by the numbers. First, the big picture. The Earth is now 1.1 degrees warmer than it was in pre-industrial times. The goal of the Paris Agreement is to keep it from reaching 1.5 degrees, considered the tipping point after which things get ugly. Our trajectory is bad. 2010 to 19 was the warmest decade on record. At our current emission rates, temperatures could rise 4.4 degrees in the next 80 years. The UN says to reach our goal, emissions have to drop 7.6% a year out to 2030. And to hit those same targets, the world needs to drop fossil fuel production by 6% a year till 2030. Instead, it's projected to rise 2% a year on average. Some good news. Canada is making progress. Emissions are down 6.7% here from 2005 levels, while economic activity is still the biggest source of emissions, driving it up almost 60 megatons. Decarbonization and energy efficiency both contributed meaningfully to the decline. But to hit our goals, the Canadian Climate Institute estimates that we'll need to drop emission intensity by 5% a year above our economic growth. But while Canada pursues its own path in reducing emissions, the U.S. is taking a very different approach, instead subsidizing heavily the transition to greener technology. So how can Canada compete? Dale Beugin is Executive Vice President of the Canadian Climate Institute. Thanks for being with us.
My pleasure, Amanda.
So, Dale, let's start right there. We have a kind of a plan in place, but now we have our big U.S. neighbor planning to spend heavily, draw a lot of investment and new business on clean tech to its market. How much of a threat is that to our own agenda and roadmap?
Well, I think the Inflation Reduction Act, that big piece of policy in the U.S., has changed the game for sure. It has made investing in low carbon, clean growth projects south of the border maybe more appealing than here. That being said, we're not starting from scratch. Canada has maybe a big advantage in this game, which is carbon pricing, a steadily rising carbon price that's going to drive the incentives to invest in low carbon products, to switch to those low carbon products, to reduce emissions, to avoid paying that carbon price. So the key for Canada to stay competitive is to really make its carbon pricing advantage the core of its strategy. But nevertheless, for the new budget next week, we're looking for ways it can build on that advantage to really attract capital, to grow new sources of economic activity that are also consistent with low carbon growth.
So there's a couple of ways to approach that. One is, we just saw recently, of course, Volkswagen will build a gigafactory for EV batteries in Canada. That's a win in some ways. We don't know, Dale, what we spent on it. We suspect strongly that there are government monies that went to lure them here. Is that the kind of spending that makes sense? Because sometimes we think that's picking winners and losers, and we wish government wouldn't do that.
Yeah, we've talked a lot at the Climate Institute of trying to crowd in private dollars to this transition to make sure that it's not just public purse that's driving this investment, but it's private dollars. And the best way to do that is, again, to reinforce Canada's carbon price, to make it more clear that there's certainty in the path of carbon pricing into the future, to give that long-term investment certainty that those investors want. But again, there's a role for the public purse here in lubricating those investments and attracting that investment, but the bulk of it should come from the private sector.
I know the Climate Institute was one of the bodies that consulted with the finance minister. Obviously, there's some thinking going on about the vision of what we do here. And there is a suggestion that the grid is going to be part of the budget play, that there'll be money spent on expanding it. It's by necessity. It's not big enough to carry the weight of the future electrical needs. Is that, do you think, a core place that government should play?
Absolutely. That's a core place where government should play. We've done the scenarios exploring what net zero looks like for Canada, and across all of them, electricity and clean electricity is a huge part. It enables switching away from burning fossil fuels towards using clean electricity. But to do that depends on having enough clean, reliable, affordable electricity available. One of the roles in government, one of government's role is to build the infrastructure and to help enable that system to grow, to meet that growing demand. So I think that's absolutely a piece. It's also critical both for the competitiveness of the economy in the long term. We're hearing more and more about firms investing in Canada looking for clean electricity as one of the main reasons why they do so. It's also for affordability. It's a way to make sure that costs of energy over time are going to decline for Canada rather than increase.
Dale, so good to have you with us. Appreciate your time today. Dale Beugin is Executive Vice President of the Canadian Climate Institute. One thing seems obvious about the transition from fossil fuels to new technology, and that's that in the short term at least, it will be more expensive. In fact, from new fuels to extreme weather adaptation, climate inflation could be the new reality. So how do we tackle inflation using old tools? David Dodge was Canada's central bank governor from 2001 to 2008, is now a senior advisor at Bennett Jones. David, great to have you with us.
Hi, Amanda.
So have we come to terms with so-called greenflation, this idea that the greening of our economies will be naturally inflationary?
Well, it's going to require more investment in the short run, both in the public sector and the private sector. And that means that for the country as a whole, a smaller share of GDP is going to be left over for consumption than we had before. That's just the nature of the game. And so for a while, we in Canada, both business and consumers, are going to have to get used to the fact that in order to release resources for investment, they're going to have less consumption.
So does that mean if you were the central bank governor today, looking down into your crystal ball 5-10 years down the road, do we have to change what is an acceptable level of inflation? Do we say for the next 5 years it's going to be 4% because that's just the way pricing is going to work?
No, because if we said it's going to be 4%, we run into troubles. It'll be a lot more than 4%. So the issue is not to change the target. The issue is to conduct policies to free up room for investment. That's what's critical. This is not a banking problem. This is not a monetary problem. This is a problem of fiscal policy and regulatory policy to facilitate investment.
What is the best way to do that? How do we free up, as you say, and create incentives for investments?
Right. Well, one of the most important ways is to provide investment tax credits, especially in those areas where we need the new investment. That's on the private sector side. On the public sector side, especially since you remember, much of our utilities, our electrical utilities, are publicly owned. It's going to require investment on the public side to provide that infrastructure.
So we've got demographics that are likely to help send prices higher. You've got this green transition that are likely to send prices higher. The extreme weather alone will probably disrupt our food pricing for the foreseeable future, if not forever. It feels like high prices might be here to stay, but you're saying central banks can stay committed to keeping them low. Does that mean we're going to live in a higher rate environment for the foreseeable future?
Absolutely, it does. And not just in Canada.
How high do you think we need to see if you were guessing of where we settle in over the next decade or so?
I don't know precisely, Amanda, but if you think of the range that central banks have looked at in the past to hit 2%, it would mean a policy rate in the order of 2.5%. I think going forward, if that 2 to 2.5% was right in the past, I think we're looking at 2.5 to 3 or 3 to 3.5 in the future, which means that we're going to have positive real interest rates, in essence, for the first time in 20 years.
David Dodge, former central bank governor, senior advisor at Bennett Jones. Coming up, we do get a budget next week. How will it walk that fine line between cooling inflation and helping with affordability? That's still ahead. But first, this. Talk about going out with a roar. The last gas-powered Dodge Challenger will also be one of its most powerful. In fact, the 2023 Challenger Demon has so much rotational torque that its producer, Stellantis, had to toughen up the rear drive shaft with materials borrowed from the aerospace industry. New rules mean that gas guzzlers like this one will be replaced with electric vehicles. Meanwhile, the Demon's price is far from angelic at close to $100,000 US. Some will call this car a relic. Others will definitely call it a collector's item. It's all in the eye of the beholder. We're back after this.